Hello and welcome to Weekend Wisdom. I'm Dr. Raoul Mathur from Mathur Dental Education. I hope everyone had a great week practicing dentistry and everyone's backs and shoulders are not too sore. But in this week's episode of Weekend Wisdom, I wanted to discuss something that I hadn't discussed before, and it's actually going to start with a statistic. It's a bit of an alarming statistic, but the statistic is basically saying that in 2004, the number of dentists that own their own practice was at that level was at 80% or 85% rather. And now 20 years later, we're at 70%. So if you think about it, 20 years later, the number of dentists that own their own practice has dropped 15%. That's alarming. Furthermore, for females, that number is at 60%, even more alarming. So the question I ask is why is this? What's happened over the last 20 years to make dentists move out of ownership? Has the deal gotten worse? What I'm trying to say? Is there less chance of success? Is it the concern about corporate dentistry coming in? Let's delve into it a little bit. So I put together a few slides and you can see some of my computer issues popping up here. You can see I've put together a few slides. You might recognize a few of these slides from module 1 of my program, How to Start and Run a Dental Practice. If you've seen it before, you'll recognize a few of the points I'm trying to make. If you haven't seen it, I actually recommend that you can go watch module 1 for free. It's on our website, mathurdentaleducation.com. So I want to start with a couple of the reasons that I've noticed. I've done some research in this. I've talked to dentists all over from multiple countries. A lot of it stems from fears that are related to ownership. Let's go through some. So, number one, debt levels are increasing. Competition seems to be increasing. We're starting to see practices fail for the first time, and the continued rise of corporate dentistry. So debt, the average student loan is over $300,000 and rising. Now, some of you might hear that and say, well, 300,000, I wish. I'm closer to 4 or 500,000. But this is 4 times higher than the generation of dentists that graduated in the late 90s. The average startup practice debt is increasing because the average startup dental costs have increased significantly over the years. Debt increases the number every month that practitioners have to hit in order to break even and start paying themselves. A higher break-even point number can start to affect the decision-making of dentists during treatment planning. Increasing competition. Well, how many of you have heard this? There seems to be a new dentist on every corner these days. Well, even in less populated cities and towns, competition is growing in the dental field. Can we still attain that coveted 1 to 2,000 ratio? If you haven't heard that, if you haven't heard that, it's referring that one dentist for every 2,000 members of a population. But, that's been changing. Over the last few years, I've heard 1 in 1,800. There's more and more compromise that's happening as competition is increasing. And that helps add to the fear about opening and starting your own practice. How can we compete when professional businesses have gotten into the dental field? Who am I referring to? Corporate dentistry. Practice failure. When I started dental school, I have an uncle, he's retired now, and he's a surgeon, and he said, good job. Dentistry is recession proof. But like I said, we're seeing practices fail where we didn't see this before. So is dentistry recession proof? All types of dentistry recession proof? The golden age of dentistry was a time when graduates used to leave school and open an office right away. A week after graduating, they're putting up a sign and a shingle. And then, of course, the corporate dentistry. Organizations that have the funding to operate dental practices similar to the business practices of successful corporations. They're able to leverage their size into creating business advantages, which help them lower costs. And in addition, they may possess the business knowledge that will make competing with them a daunting task. They can have different sizes and business models. And it says later in the course, I'll describe my ideal practice model for this economic environment. This is a slide from module 1 of the program. But I do go into detail about that, talking about, you don't really need to be scared of corporate dentistry. It just matters in what kind of practice model you adopt. And we go through the practice models, of course. So, I mean, if you've listened up to this point, you might think, well, what's Raul trying to do? Is he making an argument for us to not go into ownership? And of course, that's not the case. In fact, I have a whole coaching program and an online program for how to start your own and how to run your own. Practice ownership is absolutely worth it. It is, but only if it's done prudently. So, prudent, acting with wisdom, thought, and caution for the future. Let's listen to some optimism now. So, the dental industry is growing. The dental industry is doing over $158 billion a year in the United States alone. The dental market is growing by 3% every year worldwide. The market size of the dental industry in the US increased faster than the economy did overall. So, why are we having such growth? Well, there's an increase in disposable income globally. There's an increase in awareness of oral health importance. There's an increase in demand for cosmetic dental procedures. There's an increase in geriatric populations keeping their teeth. And there's an overall increase in population size. Large dental organizations are competing for market share in a growing and lucrative industry. So, is there a place for a single or small group of dentists to open an owner operated dental practice and be successful? Absolutely. Small ownership practices can thrive if they are well thought out and they are efficient. You can lower your risk greatly and control the downside exposure by being well prepared. Now, for those of you that have watched Module 1, you'll recognize this gentleman, Monish Pabrai, and he has a very interesting philosophy about how he approaches business. First, a little background on him. He made his fortune in the 90s in the IT industry, but he sold his IT firm and got into investing and became quite successful. In fact, he's friends with Warren Buffett. But he has the saying, heads I win, tails I don't lose much. Basically, this is him speaking. If you study entrepreneurs, there's a misnomer. People think that entrepreneurs take risk and they get rewarded because they take risk. In reality, entrepreneurs do everything they can to minimize risk. They're not interested in taking risk. They want free lunches and they go after free lunches. Well, that's interesting, but how do we apply this business mindset to our project of starting a new dental practice? This heads I win, tails I don't lose much. How do we apply this to our situation of wanting to start a dental practice? And the answer is by being able to be more efficient compared to other dental operations while not sacrificing any quality or patient care. Let's dissect this answer. By efficient, I don't mean cheap. I mean coming up with the same quality of practice, but with less expense, but the same quality. And when I say other dental operations, I'm referring to the traditional way of starting a practice. And that's you call up your supply representative and you let them know you want to practice and they give you a big quote. And they will do a lot of that work for you. And then while not sacrificing any quality or patient care, is pretty straightforward. I'm not talking about um, using cheap equipment, cheap materials, gray market materials, nothing like that. So if you think about Mathur Dental Education, we are focused on two subsets of dentists, uh, starting and running. Starting are for you dentists who are, it might even just be a thought in your head or it might be a burning desire to start your own practice. You might be working as an associate somewhere and you know that at some point you're going to do it in the future. Mathur Dental Education is really focused on you. But the other group that we're focusing on are people who have a practice already, but maybe they want to make some improvements. Maybe it's not going so well and they're wondering how do they do it. So if you're starting, I think a goal for you should be to be able to set up your practice with a savings of $200,000 to $300,000 compared to other startups. And by other startups, I'm talking about those that go through the supply company. For if you're running, or if you're starting and then you are running, You want to be able to run your practice effectively and efficiently in order to lower your break-even point every month, thus lowering risk and increasing profit. So, I want to give you an example of this heads I win and tails I don't lose much philosophy. And the example is me. Uh, this is the formula that I use when I run my practices, or this is the business concept that I always abide by. So my first practice when I was opening, I was looking at setting up a 5-op practice. And I got quotes from the supply companies coming in at around $800,000. I looked around because I was thinking, oh, maybe I'll buy a practice. I wasn't too experienced in this area yet. And I looked up the cost of a failed startup practices. So these are practices that are for sale. Now, depending on where you are in the world, this may be called something different. They're not going to be advertised as a failed startup practice, but you may see the sign or you may see the title turnkey practice, literally meaning you turn the key and there's your practice. You might have a lot of equipment and it all might be within the last few years. And for whatever reason, it didn't work out for the owner. So, therefore, if you look at the business decision or proposition you're facing, it's either A, you're successful and you go off into the sunlight with your successful practice, or B, you're unsuccessful. And then you're selling your practice for, in my situation, for $700,000, which is a loss of $100,000. And then that's not including fees from the lawyer and the broker and the interest on the debt. So the important thing that I think you need to do is what I did. You need to change that dynamic. You need to change your outcomes, your potential outcomes. So I was able to start up for $500,000 for that same 5-op practice. Did I buy cheap chairs? Did I use cheap materials? Did I set up in the absolute cheapest part of town? No, but I did it myself. I didn't go through the supply company. I didn't know exactly what I was doing. I do now, and that's basically what my program is about, teaching you how to do it. But if you think about that, I changed my worst case scenario. So now my potential outcomes was A, successful practice off into the sunset, or B, failed practice, but I have a practice that's worth 700 that I built for 500. It's the market value is 700, but I built it for 500. So my worst case scenario is a gain of $200,000. So that's not heads I win, tails I don't lose much. That's heads I win, tails I win, but just a little bit less, which is a great way to reduce risk. This is a free lunch, so to speak, to use Manish Prabhai's saying. But this is the dynamic that you need to set for yourself. Now, wherever you are in the world, this means that you need to find out a few things. What is the cost you're being quoted from the supply companies to start a practice through them? What is it cost for the turnkey practice for you? And then where do you need to come in with your budget to set up at least, you may not need to make 200, but you need to make sure you're not losing. You need to create a heads I win and tails I don't lose type situation. Does that make sense? Okay, so then when I was practicing in Australia, I had a good friend who was talking about owning and their thoughts on it, and they were quite down on it. They were comparing incomes. He was at a business associateship, and he had a friend who had started, and maybe they were doing well, they weren't doing well, but he was just comparing the incomes between the two. He says, "I don't really know if I want to own a practice because we're earning about the same. It doesn't really make a lot of sense." I remember thinking that was a funny thing to say. Um, Granted, at the very beginning, I think it's a good goal to have in your first year of starting up to earn a good associate income. But if you're doing it well, you should really take off from there. And there should be no comparing between a startup practice and a practice or an associate, for example, that is just working as an associate versus startup practice. Sorry, I thought my kids were waking up. So and it's a different type of situation. If you're an associate, you are earning a living. If you're an owner, you are learning a living and you're building up an asset. So I want to talk to you a little bit about the different avenues you can take as an owner. I apologize to a lot of the dentists who are quite clinically inclined. I know there's a bit of money talk here, and it can kind of feel like it sullies everything. Um, but it's important to understand the financials of things so that you can help make a guided decision. So, owning a practice can lead down multiple wealth avenues. Let's talk about three of them. One is the eventual sale of your practice to another dentist. Two, the eventual sale to a DSO or corporation. And three, maintaining ownership of your practice over your career and the potential investment of income. So let's look at the eventual sale to another dentist. Up until recently, this was the main exit strategy for dentists. Sale of a practice was usually based on the valuation of between 75% to 125% of 1 year's revenue, depending on location. So wherever you are in the world, this could be different. So I've seen a lot of the places I've heard and talked to and seen in the United States about 75%, depending if you're in a really high end part of, if you're in Manhattan, it might be different, for example. But in parts of Canada, it's very commonly to have 120 to 125%, and it can vary. So, for example, a practice that was started at 500,000 that grows to 2.5 million in yearly revenue would sell for between 1.875 million to 3.125 million. So this would be an ROI of 3.75x to 6.25x the initial investment. So this sale would come after career years of earning over $700,000 a year. Not bad. That's one of your avenues. And you couldn't have this avenue open to you unless you're owning. Number two, the eventual sale to a DSO or corporation. Now, before all of you send me angry emails saying you'd never do that and you're not happy with corporations, I'm not here to say pro or anti corporations. That's not really my focus. My focus is on you guys. You guys are like me. We're private dentists, and I want these opportunities to be available to you. Whether you take them or not is yours, but it's important to be educated about them. So today, corporate dentistry is motivated to buy up market share in a solid earning industry. This has led dental practices to be valued completely different than in the past. So now the private equity companies that are getting involved, they own a lot of the dental companies, and they're using multiples of EBITDA to determine buyout packages. So when a corporation is in expansion mode, the highest I've seen is multiples of up to 12 times EBITDA being offered. I don't think you should expect that as your regular, but I've seen it. So for example, if you have a dental practice that's 12 years old, billing $2.5 million a year with a 25% EBITDA, which means your EBITDA is 625K. So let's say you sold on an upswing of a cycle, sold for a package of 10 times EBITDA for 6.25 million. So let's review here. You started up for 500,000. Uh, you've made 12.5x your initial investment while earning an average of approximately 725,000 during the 12-year period. Not bad. Again, something that you could not do unless you're in that ownership chair. Note, now these deals with corporates have a lot of small print, and you'll have to use people that are quite well versed in understanding these deals. They can ask you to stay on for 2 to 5 years to ensure continued production. Other conditions can exist. But as a broad scale, talking to my friends who have sold their practices to DSOs and things, this is the bulk of the package that's in play here for you. And then lastly, let's talk about maintaining ownership. There's a lot of value in simply owning the practice over a period of time. By just being in the ownership position, you can have the opportunity to create some long-term wealth. So this can involve owning the practice, but not actually practicing and just employing associate dentists. So for example, a dentist that starts their practice at say 35 years old, the first 2 years, and granted, I'm not saying that if you're older than this, it doesn't mean you can't start your practice. I'm just giving a general example. So dentist that starts their practice at 35 years old, the first 2 years, they build up their cash reserve and grow the practice. At 37 years old, they start contributing to a low-cost investment index such as the S&P 500. From the ages of 37 until 60, they contribute an average of 200K a year to the index. So the index returns an average of 9% per year, as it has historically. So at age 60, they have a practice that's grossing 4 million. I think we're being conservative, granted that it's been operational for 23 years it is, and an investment portfolio of 16.6 million. That's a net worth of 20.6 million. Again, not something that's available to you unless you have the income from being in an ownership position. Now, some of you might look at that and be like, an average of $200,000 a year. What are you talking about? That's a bit rich, and um, that's providing a lot into the investment. That's an average. So remember, sometimes when they're owning for over a decade, contributing $200,000, oftentimes it can help to keep it within their corporation and not pay the tax off that. So this is things to talk to your accountant about. Now, in this example, I did not include any cash that they may have saved along the way. So this is actually quite conservative. Granted, this is not to be construed as any investment advice. Please consult a financial professional. But I just wanted to highlight the opportunities that exist to you if you are an owner. So I'm not going to plug this too much, but I just want you to know that it's available. This is my program, How to Start and Run a Dental Practice Successfully, 23 modules. So part one is modules 1 to 12, and that is for taking you from where I envision a lot of you may be right now, thinking about wanting to start a practice, where it's in the back of your mind or quite a bit in the forefront of your mind, and it'll take you to your fully built out, step by step to your fully built out practice. And then part two, considered part of the same program, is Flying First Year Success. So this will take you from your built out practice to the end of your first year, which has been very successful and you're earning quite well. Okay. So that's the end of it, our episode for today. If you have any questions, remember we do these every week. So send your emails to me and I will read your questions in video and address them that way for you. So my email is mathurdentaleducation@gmail.com. Reach out to me. I'm filming this on Friday night. So everyone in Canada, happy Thanksgiving. To those on the other side of the world, happy Saturday morning. And I hope you have a nice, relaxing weekend. And I wish you all the best this week coming up in practice. Take care.